Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending July 19th, 2019. This is a daily chart of the S&P 500. There's some context. So the month of June was very strong, opening up here, and of course that was due to Jerome Powell, central bank dovish bias easing. And in July, it's just been really quiet markets. Volume has been falling. So this week on Monday, we posted a new record high, and CNBC was bragging about that. New record high. I don't turn them on that often, but I just had to see what they said. Because this day was up 50 cents. A $3,000 product was up 50 cents. You can see over here. There it is. Of course, CNBC won't tell you that this was the smallest daily range in almost a year on the lightest volume in a year and a half. So the high to low range here was the smallest since September 19th, which is over here. This was the day before the final record high, before all this happened, and it was the lightest volume since November 24th, I believe it was, of 2017, on a half day after Thanksgiving. CNBC won't tell you those kind of things. And the S&P came down the rest of the week, so here's Tuesday, Wednesday, Thursday, and Friday. Actually, by last Friday, over here, we already saw a negative divergence in QQQ. By Monday, we saw a negative divergence in SPY, and by Tuesday, IWM, which has been trading in this really flat lateral range, not moving up higher highs in July, also put in a negative divergence. So I will show you those from the actual post on Tuesday. So this is what QQQ looked like at the time. Here was Monday, and here was Tuesday. So we already had a negative divergence from Friday. It kept on building into Monday and Tuesday. And here is SPY. So it really showed a negative divergence on Monday. Over here became very clear. And IWM, as I said, has been trading in this range through all of July, not making higher highs, certainly not making record new highs. And here's that range on a 15-minute chart all through July. And you can see it dip down towards the end of the week. And as of Tuesday, this is that same range on a 1-minute 3C chart. And you can see as of Tuesday, it started leading negative, or leading negatively divergent. And price actually kind of followed this down and didn't quite break below that range. Here's IWN. This is where that signal started leading negatively divergent. So price did follow it down, and then over here and over here. But we still have negative divergences there. The S&P ended down about 1.25% on the week. So some pretty ugly closes down at the low of the day over here on Wednesday, and again here on Friday. Those do not look good heading into next week. And as I just mentioned, we're still negatively divergent here on the week. And on this little rally attempt on Thursday and Friday morning, did not confirm that either, making lower highs, and price ended lower for the day. So this negative divergence probably is not any worse than it was over here, but it has not gotten any better. If you're watching the S&P sectors, they started breaking trends that they really haven't broken since June. On this entire rally in June into July, most of them have held some kind of an uptrend or consolidation, and they started breaking those trends as early as Monday. And on the whole, about 5 of the 11 sectors did end up breaking some kind of uptrend last week. So one of the first we saw was the energy sector, due to crude also breaking down, having a terrible week, and losing about 7% on the week. So here's that June-July uptrend. Risk assets, doesn't matter if it's crude, stocks, they were all going up here. And this is Monday over here where we start breaking that trend, Monday, Tuesday. And let me show you the energy sector. Here's that same uptrend from the beginning of June. So this was the energy sector breaking down Tuesday. Here's the technology sector from early June with a ascending wedge. I'm not a big fan of trading these wedges. I've seen a lot of them this year. Break, kind of go sideways, and then start another wedge. But it is a bearish pattern in that you have a strong rally here, and participation price ranges are narrowing. And I think I wrote like Monday morning of this week, I'd sent out a chart of this and said this is getting brittle. And it was the next day, Tuesday, it broke down here. On Wednesday, 2 other sectors that have been really strong in June and July. The communication sector here, 60-minute chart, going to go to a 15. Here you can see the trend into July. So that broke down this week. and also the consumer discretionary sector. Again, you can see a very strong trend through June and July. This is mostly through July. Breaks down this week over here on Wednesday. And on Friday, the healthcare sector kind of flirted with a breakdown. Here's that sector. It's been kind of just going sideways, consolidating, and over here started to flirt with a breakdown here. It's got a little bit of support in the area, right there around 91.75 or so. So it's pretty close to breaking down as well. The sectors that have not, we'll run through those real quick. It's basically the defensive sectors, the three defensive sectors. So here's one on a 60-minute chart, utilities. Came down to the bottom of this trend, did not break it yet. Here is consumer staples. This is a trend that goes back a ways here. So you can see it actually coming from January. So that's an important trend. It did break it over here in early June, but still above right here around 59.50. And real estate, which has been a sector I've really liked. It's trended very well, as you can see over here. But it is getting into one of these things. This isn't really a break and a back test of the trend like we saw before with energy sector, but I still don't like it. It's not a great development here. You have a lower high, and really you're kind of establishing a new lower trend. So not a great look for that sector. And then the material sector, which is very lightly weighted. And here it is from its June rally uptrend. This is one of the earlier sectors to really start improving in June, coming out of this May decline. But the two sectors that matter the most, and had they broke down this week, it could have been a lot uglier, were industrials and financials. So let's look at industrials. And here's that June through July uptrend. They had been doing really good last week, around last Friday, with transport leading them. So this sector did not break this trend. It's one to watch. And then, since it was earnings season kicking off with the financials, and here's the financial sector from June's rally. So you can see it's very close to testing this trend line. It did come down on the week. Remember, all the big banks kicked off earnings season. So this was not a great response to their earnings. But again, it did not break this trend. You can see it's right there around 27.90. And then what you really want to keep an eye on is small caps. Here's IWM on a daily chart. And as I've mentioned quite a few times, this is more than 10% off its record high. It has not been confirming the S&P and the NASDAQ and the Dow. It hasn't even made higher highs here for this run in January. And right now, like I just showed earlier, it's trading in a very flat range. Again, not confirming even the pushes higher in the S&P for July. Instead, it's been trading in this range. You can see July 1st here. A very flat lateral sideways range. Flirted with breaking it this week. This was actually one of the things I thought looked pretty decent on Thursday, and the market might hold up because they started acting a little better. But I do have to say one other thing, and that is small caps had their worst relative performance against the S&P since we came out of the financial crisis or the last recession. So small caps giving a recessionary era signal of relative weakness. As of last weekend's video, we were looking at silver right in this area, and it was a bullish flag. So this is Monday over here. Took off. So gained about 6%. My target, rather, was $15. It actually broke through that, $15.50, which happens on these measured move targets. But generally, they tend to settle, price tends to settle around those targets. And this is also an area of resistance from a big consolidation. Let me see if I can move that. I'll do a 2-day chart here. So you can see this big consolidation. So this is running into that resistance. Almost broke out this week. I believe I had gold in the last video. Symmetrical triangle. It was inside this before the start of this week. So silver actually led gold higher. Silver came off something like a 27-year low in price relative to gold. So gold was actually dragged higher by silver, and it had a pretty good week this week. You may have heard about New York Fed President Williams speaking on Thursday. The market took away from his speech that the Fed was going to cut rates by 50 basis points in July instead of 25 basis points. So that slammed the dollar. The dollar went down like a rock. Gold and silver moved a lot higher. And then a couple hours after his speech, he had a press secretary go out and say, no, that's not what he intended. They tried to walk it back. But the Fed funds futures market went from pricing in something like a 30% chance to something like a 70% chance, and they could not walk that back. The New York Fed released another press release saying this was not his intention. So they desperately had to walk that comment back before the Fed goes into blackout, which started on Saturday. And that's why you see gold and silver come down. And as far as stocks, if we pull up the SPY here, and this is a 5-minute chart of the week. Here's Monday. This is where Williams made that comment that the market took very dovishly. So you could see what was happening this whole week was making lower highs, lower lows, and even in the intraday consolidations, you'd get a lower high here, price would come down, you get a lower high here, price came down, and it looked like we were set for another lower high here on Thursday until Williams spoke, and the market went up, and here is the New York Fed taking it back. So the market basically erased all of these gains from Williams' comment, and also took back all of those expectations for a 50 basis point cut in July. So this is about as good a place as any to wrap up this video. You can see what happened over the last week. Not real big impulsive selling or sharp declines or anything like that. Just pretty persistent. So you can see how that worked out and where we ended at the end of the week, near week lows at the low of the day on Friday. And as already mentioned and shown, ended really with a negative divergence still in effect. So here it is coming into the week. Prices go down, follow it, and here it is on this bounce here. This is the Williams bounce on Thursday. Here's the decline. So on Thursday, even as it was bouncing and into Friday morning, no confirmation here with 3C making lower highs. That's how we will leave it. I hope everybody has a fantastic weekend, and we'll pick it up again on Monday.